which we all as Indians love. Now, what is common between these three images and Anish as an investor? Temples, which have stood centuries, tell us the structure. These were constructed when modern technology or construction materials were not available, but still they stand the test of time. Chess is a game not about the best move, but not making the wrong move. And in cricket, the lovers of cricket, exponents of cricket say declaring a match, the traditional test cricket, is what is more difficult than deciding bowling change or field placement. So we are talking about structure, we are talking about timing, and we are talking about judgment. Anish, as an investor, as a fund manager, combines all these very, very effectively. And we believe that is what creates investment leadership. Decades of experience, research at different entities like Barclays, Bernstein, and a fund manager with one of the largest fund house in the country, proven track record in managing different segments of the market, and happy to welcome Anish to DSP, his CIO, and his first interaction with a large segment of our partners. Over to you, Anish.
Thank you very much for the kind words, Usha. It's a pleasure to be here. I always feel that our partners play such an important role in doing the difficult job of handling clients for us. So it's always a pleasure to speak with them.
Sure. So, break the ice and a small question. What's your investing journey very quickly? I mean, how did you become an investor, your research background, so that the audience gets to know Anish a little better?
I'll say that I'm still an analyst at heart, right? There's nothing more than I enjoy than figuring something out, how an industry works, how an industry creates excitement, which is sometimes unjustified. And like my journey has been, I enjoy economics. That's my favorite subject. And this investing allows me to apply economic thinking to practical life situations. So that has been the reason why I've stuck on in this career for so long.
So I'll touch on to it a bit later when I ask you about some of the funds that you manage. But let me get on to your investing philosophy. There's something very interesting you have shared in your few weeks here. I just want our audience to understand that rational and irrational part of the market philosophy, which you very beautifully capture.
So look, there are two main aspects to it. One is that markets are rational over the long term, but at the same time, markets are not rational at every point in time. That's the reality. Second is that economies always go through cycles. We see those periods of booms and slumps. In booms, demand is very strong, profitability is very good. In slumps, businesses are lying idle. These are two realities of the world. So the investment philosophy has to follow on from this. So when you think about it, it's obvious, right? That if the market is in an irrational zone, then you have to choose. You can either try to outperform, or you can remain rational. It is logically impossible to outperform while remaining rational if the market is irrational. It's logically impossible, right? And at that points in time, it's really important, in my view, to remain rational, not fall given to the FOMO that happens when everything's going up irrationally or going down irrationally. Second is that given that cycles are a reality, both top-down and bottom-up thinking are relevant, right? It doesn't make sense to say I'm only bottom-up. I don't care what's happening to the macro. It doesn't work, right? So you need to have, irrespective of whether even if your strength lies in bottom-up stock picking, you need to know the top-down context. Otherwise, you can do a lot of damage to your investors, right? So both top-down and bottom-up thinking is critical. The other aspects are like you need to have a disciplined process around asset allocation, right? And particularly if you're managing large sums of money, it's important to move in small increments, right? You need to be able to act contra. One, like I feel that there are many ways to be smart in the market. You can be a growth investor, you can be a value investor, you can be a quality investor. But the one thing that I don't agree with is being a momentum investor. If you like something at 100, you should like it less at 200. Is the simple way to put it, right? So And that is something like which will underlie all our funds here at DSP, that you
is
can
the
have
simple
different
way to
styles,
way
but
to
don't
put
be
it, right?
right. So
So, in other words, what you're saying, Anish, is don't get carried away in these euphoric times
yeah,
when it happens and try to outsmart, which is often what we see investors putting pressure on most of our advisors and, ending up making mistakes. And as a follow on question on that, if you look at the markets, like you said, being irrational at certain points of time, 2024 September was the peak of the market. And from there to today, as my audience can see on the screen, most of the indices have not delivered great returns. While the narrative was something very different, the flows into small caps at that point of time was one of the highest, unprecedented flows we saw into the small cap segment. And you're someone who is quite vocal about your views on small cap, how to look at these kind of businesses, what are the risks involved, etc. So just want a little bit of time spent on that segment.
look, so small cap saw a lot of flows in the last, say, 3.5 to 4 years. That's because primarily those flows are what we call reflexive, right? They were following performance. And that is the mistake, that is the most common mistakes in the market. You get excited after something has delivered performance. And I've all like over the last year and a half, or in fact even over 2.5 years, I've been of the view that there is almost a bubble in small caps. See, if you look at the long-term history of small caps, right, uh, you'll realize that the period of performance was actually very short, from 2020 to 24, effectively, right? If you were to take a longer-term view from January 2008 to January 2020, that's a 12-year period, right, where it's like your child going through schooling entire from class 1 to class 12. So if you had put in money in January 2008 and waited till January 2020, you would have pre-COVID. Yes, that's important to note. It's pre-COVID. After that COVID hit, you would have made hardly any returns, right?
I've put it up on the screen.
Yeah, so you would have hardly made any return over a 12-year period, and people forgot that. And then in that 20 to 23 or 24 period, they delivered spectacular returns, but then it is likely to be followed by a period of disappointment. See, if you enter after performance, right, the odds are against you. That's the simple way to put it. Yeah.
Correct. Anish, also interesting. Some of the debt funds delivered similar
Yeah,
returns, better
better
returns
returns.
than the small cap in the 12-year period that you are talking about. Small cap also brings in a conversation on corporate governance. Uh, would you like to share something on that?
So two aspects, right? One is how do you evaluate corporate governance, and two, what patterns do you see in terms of corporate governance? One is, for me, the best proof of corporate governance is the dividend payout.
Dividend pay.
Dividend payout. If a company is like, tells me the quality of earnings is genuine and the money is being returned to you, you get the cash. You can decide what you want to do with it. Invest it back in the company. Invest it in another company. Now, in terms of that's the what. How do you evaluate corporate governance? Right? There's no better proof than no matter what the company's profits or my shares. Second, I'd say that look, what
Now, in terms
patterns do
of
you observe? You observe that corporate governance is
that's the
cyclical,
what. How do you evaluate
right?
corporate
So at
governance?
the
Right?
top
There's
of the
no better
market,
proof than
no matter promoters want to raise money, so there will be a lot of good corporate governance initiatives, a lot of investor conferences, very extravagant guidance about what the beauty of and how beautiful the outlook is for the next 3 4 years, and a lot of investor access. All questions will be answered. Then after money has been raised, people will disappear, and there will be no investor access when the reality of the performance plays out. So at so from an investor's perspective, right, it is very important at the top of the market to not fall for the stories, right? Do not get carried away by the stories that are being told by the investors, by I get promoters in sorry by promoters, the investment banking community, the private equity community. All of these you have to be very careful of. Yeah. So particularly for companies that don't have a history, right? If there's a history, in fact, I love companies that do very few meetings with the investors, right? deliver profits in line with what you would expect in an industry. So if it's an cyclical industry, they underperform, like performance is not good in a down cycle, that's okay. That's part of the game, right? That's part of the business. But and they pay dividends consistently.
So, a word of caution, couple of things on small cap: don't chase returns, don't come after the returns have gone, and then in bull markets or in euphoric times, be conscious of what narratives you are being fed.
Absolutely.
Fair. Anish, I'm going to move into the next one, which is a category which was not very popular as far as the market was concerned, came into being a couple of years back. You have built that category. There has been fantastic outcome for investors who have been part of yours. A tough category to manage because, like you said, your love for economics and the macro outlook plays very important role in managing a business cycle fund. But equally important is sector rotation, stock selection, so on and so forth. So I think it tests the knowledge, the understanding, the grip of micro and macro for fund management. DSP Business Cycle Fund has come to you after you have taken over as the CIO. Want you to explain your method of managing this portfolio. What should an investor, advisor look at when he's buying a business cycle fund?
So this is a top-down sector selection fund, right? So first point, it will always have a segment of sectors. To it's not a generic flexi cap. So at any point in time, there will be some segment of the market, with some meaningful segment of the market, which is whether it's sectors or industries, which we will have zero. So if you have to explain to your clients how it's different from a flexi cap, you can always show that, look, there's this segment of the market which is zero in this fund at this point in time. That will change over points in time. Now, how will that change? That will change on the economic cycles. So what are economic cycles? As I alluded to earlier, economies go through periods of booms and slumps. We'll get to why those happen. But what is a boom? A boom is when demand in the economy is very strong. So businesses are working flat out, right? So if you're in your business, you'll find your capacity utilization is 100%. You're struggling to even find workers, or raw material supplies are a challenge because demand is so good. You say, hey, maybe I should even postpone this maintenance shutdown I should be taking, because it's so profitable to keep operating it, right? So if you were running a taxi service, should I send the car for servicing? Maybe not. That's what a boom is, right? And the slump is the opposite, right? Where if you're a factory which was operating at 3 shifts in a boom, you'd be struggling to fill 1 shift in a slump. And that happens because demand is weak. And the sectors that do well in a boom or a slump are obviously different. Now, it's also important to understand why these booms and slumps happen. Right? Booms happen when people are feeling confident, right? When there's generally confidence in the economy, and when people are feeling confident, they're willing to spend both for consumption and for investment. So you'll take the risk of buying a house because you're feeling good about your income stream in the future, right? So both spending on consumption and investment is high. And the obvious fact of the economy is one person's spending is another person's income, right? So when some people start increasing their spending, other people's income rise, and the confidence levels in the economy rise.
It's a fly.
So it's a virtuous cycle. The slump is the opposite, right? Slump is the opposite. What happens in a slump is people start feeling nervous. When people start feeling nervous, they reduce their spending. They want to save more. It's important to understand they want to save more. Now, but when you reduce your spending, one person's spending is another person's income. So when somebody cuts their spending, another person's income falls. And then it's a vicious cycle when people feel more nervous. Now, important point I made was they want to save more. But when incomes fall, there is less to save from. So actually savings fall. And this in economics is called the paradox of thrift. You try to save more, you end up saving less, right? Now, so these are the things that naturally would happen. Now, it's the policymaker's job to offset this, right? So if we are in a slump, monetary policy should cut rates to reduce the incentive to save. Remember, your savings have actually dropped because spending has dropped. but you should reduce the incentive to save to encourage people to spend more, right? Similarly, in a on the government side, they should cut taxes to encourage people to spend more, right? The government should be willing to borrow at that time, right? And or very low, and government should spend more. But very often the thinking is contrary to this, right? Now this is logical but counterintuitive, right? It's logical that when the private sector is not spending, the government should spend. It's logical, but it's counterintuitive, because what happens is when the economy weakens, tax revenues drop. So the fiscal deficit, even if the government has not increased spending, looks larger. And all the deficit hawks, they will start worrying about wrongly at the wrong point in time, start saying, no, no, this is bad. Government's fiscal deficit has increased. Why is it spending? But actually, if the government is spending, it's doing the right thing. You should actually increase the spending at that time. So the point is that policymakers' job is to work counter-cyclically to offset the cycle. If the private sector is not spending, is nervous and not spending, government should spend. Should reduce rates to try to increase spending. And if they do the right job, then the cycles are more moderate, right? The booms are less. At the top of the cycle, the government's job is to curtail spending, or similarly, the RBI's job is to curtail investment activity. So the point is, these will always happen. And the interesting thing is, I don't have to take a 10-year view whether India will grow at 8% or 10%. I just have to say, look, will this economy, is it in a slump or in a boom? And is policy action such that it will lead to curtailing the boom, and curtailing the slump, right? So will we move back towards normal? That's an easier call to take. I don't have to take a 10-year view. And the sectors that do well in a boom versus the sectors that do well in a slump are different, right? If you are in a slump and you feel, look, government and the RBI are committed to reviving the economy, then don't be in doubts about, oh, will a 25 basis point rate cut be enough? RBI will do more if required. You just have to have the confidence that slumps don't last forever. The RBI or the government have decided to fix this slump, it will recover. So you play on cyclicals, right? So cyclicals are stocks like auto, which will be beaten down at that point, banks, right? Cement, capital goods. And then you're basically saying, look, the earnings have been downgraded as much as they can be downgraded. From here, earnings upgrade cycle will start. And that's how you pick sectors.
So, in a sense, either of the situation of the economy, we have sectors to play and stocks to buy. And the best way to rotate them and identifying the economic cycle is the way the fund is managed.
Exactly.
Right?
Yeah.
Anything else?
So the advantage is for an investor, from an investor's point of view, right? Very often investors like to invest in sector funds.
Yes.
But what happens is they come in right at the top when the sector has already done well.
Yes.
Or even if they've come at the right time, they don't exit. Right. So here, like, if you think we understand macro, and if you, like, many times even partners ask, what sector do you like now? So I say, if you're going by my recommendation, then might as well take the business cycle fund and then stick with me throughout, right? If you trust my recommendation.
Multi-sector.
It's a sector rotation.
Right. Sector rotation. Fair enough, Anish. Thanks for a very detailed answer on that. I want to ask another question to you, which is again a category that you have managed. It's not a very exciting category for a lot of investors and partners. They say that index is good enough. It's a large cap category, but the blue chip companies form part of that index. And very often I've heard you say that today the value is largely in the large cap space. Again, a category that you have a fantastic track record. You have taken over at DSP to manage that portfolio. The stocks have not done too well in the last couple of months or quarters. What is your take on that? How should one look at a large cap as a fund? What is its power to generate alpha for an investor?
So a few points, right? Because there are two or three aspects that need to be addressed there. One, over the large cap index.
Yes.
Then the second is the comparison between large cap and small cap, right? So look, there's 10 years back, this was a very big debate whether large cap funds can create alpha or not. But now, if you look over the last 10 years, quite a few of the large cap funds have created alpha. So the evidence is with us. Second, like I know passives are a very hot topic, but let me put a simple proposition to you. If you like something at 100, should you like it more or should you like it less when it's become 200?
Less.
Less. What does the passive fund do? It invests more at 200 because it's become a larger part of the index. So conceptually, I'm not saying I will beat that passive index, but somebody who follows the discipline of trimming, reducing weight should be able to beat. Theoretically, I don't think it's impossible, right? It doesn't require a genius to say, look, if you like something at 100, you should like it less at 200. So I do think, like, even conceptually, one should be able to think about active investing. My own philosophy as far as large caps is concerned, look, I appreciate that large caps will have not that many multi-baggers, right? So you're not looking for searching for multi-baggers, but you create alpha by avoiding the difference between the 20th and 25th is not that much. Maybe the difference between the 10th best and the 20th best stock is not that much, but between the 20th and the 80th stock, there's a big difference. So if you put a lot of effort into risk management in trying to understand where are the pitfalls and avoid the stocks that end up in the bottom 30%, right? The entire effort is focused on, let's not worry about whether this is the best or the 10th best, but is it likely to be in the bottom one third? If you avoid the bottom one third, you do well, right? I mean, the second point I like, and this again is my personal, other people may have a different approach. Like I have observed that if you are consistently second quartile, which means you don't fall into third or fourth quartile, but on a 1 year basis, right? So if you're every year you are second quartile, then on a 5 year basis you end up in the top quartile.
Interesting.
Right? And don't confuse this for mediocrity. You're not
Yes.
right. It is consistency and mediocrity are different things. To be second quartile, you have to be very disciplined about risk every year, and over a 5 year period, you'll end up near the top. You had started with sports analogies, right? Uh, I always say, look, for me, this is like, and a lot of people follow cricket. This is like fielding in the slips. You don't have to do anything, but you have to be ready to act when if there, right? So, like if you hear a good coach on fielding in the slips, he'll tell you you have to only be looking at the outside edge of the bat. That's it. You're not looking at the bowler. You're not looking at what anybody else is doing. Not listening to the crowd. You're only looking at the outside edge of the bat, and you act when an opportunity arises.
Anish, you're mentioning about avoiding the bottom 30%. In a segment which has 100 stocks, which is very well researched, you still find there are pitfalls, or you think there are pitfalls to avoid.
Yes. Yeah.
All right. That is a very interesting point for our viewers, that being consistent in Q2, because the typical tendency is to look for the best performer of the last year. But here is a very different dimension.
Yeah, in 3 years you'll be fine.
Yeah, fine.
Yeah.
So be quartile 2
Consistently.
consistently
Yeah, don't
on a
forget.
yearly basis, and then you see how it plays out over a longer period.
I mean, that has worked for me. I'm not saying
Sure.
other styles are not valid, but that has worked for me. Yeah.
Yeah. So let me move on to another question, which is obviously bothering a lot of our partners today. We see that FIIs have been pulling out left, right, and center, and a huge interest of Indian investors to go global. Suddenly, there is a lot of interest into investing in global funds. Gift City is opened up. There are choices available. Uh, how do you look at both these dimensions, Anish?
So, firstly, like let's look at the FII question. See, I have a very simple philosophy. There are things that you try to predict, and there are things that you try to react. Or not try to, you react.
Yes.
Reaction you can do, right? There's no try to, you can react.
It automatically
Yeah,
happens.
right. So there's things that you try to predict, things you try to react that you react to. Flows I react to. I don't try to predict flows, right? Flows are based on moods. It's very good topic to discuss over dinner, but really there is no quantitative there's no real good model for predicting flows. I have not come across any. And anyway, if you're buying based on flows, that there will be flows, you're buying on the greater fool theory, which is not a good way to invest. And the third thing I find is that even if there are flows, which means inflows, supply also gets created. And that's what you saw in small cap. Ultimately, what capped the small cap returns, there were still flows, inflows. But so many promoters and PE came out and supplied enough that it capped the returns, right? So the flows did not generate returns beyond the point because supply also gets created, equally gets created, right? So I say, look, I'm not going to get into this business of predicting flows. I'm going to focus on the economic outlook. If the earnings are there over time, see, because flows can only influence multiples, flows do not influence earnings, right? PE gets influenced, right? The point is now whether if anyway, I say you should invest at least for 3 years. You should do the math. I'm not going to give a number because I'm not allowed to. But say if grow at X% for 3 years, earnings grow at X% for 3 years. Even if the multiple comes down from 21 to 19, if that earnings growth is a good number, you'll not be badly off, right? So there's no point discussing flows actually. As far as Indians investing overseas, look, I mean, I always recommend some diversification. And at this stage, I'm not saying overseas markets are more attractive than in the Indian market, but I think from a diversification perspective, if you don't have any exposure, it makes sense to have some exposure.
Interesting segment or a category which got a lot of flows last year was the multi-asset category, the ever popular dynamic asset allocation category, hybrid range, Anish. Suddenly they have started getting far more traction, and the multi-asset category did get a lot of interest because they have an exposure to commodities. Did very well, and some of the funds like us do have a global exposure as well, which also contributed to the returns. At this juncture, considering the economic environment, the valuation, the overall, global and the domestic environment, how would you place hybrids for an investor, and what should our partners be doing?
So asset allocation, as opposed to just any like a standard hybrid, right?
Yes.
I think asset allocation products are very good products for the investor. And see, the good thing about asset allocation is, particularly, they should be run with an objective, dispassionate model, right? When the valuations are attractive, it should invest more. And the other thing which people miss, right? They only think about the extremes. See, if you're running a model consistently with asset for an asset allocation product, even in a flat markets, right? If you're doing the +1 +1 -1, you'll generate some returns, right? If the market has been flat for 2 years, it would have moved up and down. If you were disciplined about asset allocation, increasing the allocation when the market dipped, and decreasing it when it was down, you create some returns. And obviously, you create the mega returns if there's a big crash and you deploy at the difference between DAF and MAF. See, look, it depends on whether you're taking gold exposure outside or not, right? If you're anyway buying gold separately also, then the DAF might be better for you, better suited for you.
Sure.
Right. So that depends on how people handle gold. Yeah, gold. Yeah,
Or
particularly.
the commodity exposure, which is getting
Gold and
played.
silver. Yeah.
To our viewers at DSP, we do have an entire bouquet of hybrid choices: the aggressive hybrid, the DAF, the MAF, the equity savings, etc., which all is run pretty well on different models, and different strategies are playing out in that. So that is something that all of you can look at. Cash always becomes a topic of discussion, especially when times get tough or times get too exciting. How would you look at cash as a part of the portfolio management strategy?
So look, the way I think about it is each fund manager needs to have a clear strategy which he follows then over time. At the top of the market, you cannot come and say I want to be zero cash, and at the bottom of the market, so you need to have a approach that you are consistent. So the most important thing in as far as cash is concerned, you need to have a consistent philosophy. Either you say cash is part of the investment approach or you say it's not. And then there should be some quantitative thinking, just like asset allocation between cash versus not cash. At least there should be something guiding it in the background. See, my own approach is that I work with a risk budget, right? So if I'm managing a large cap fund and I'm saying, look, I'll be 40% active weight, I then cash is an option in that active weight, right? So I'll say, look, if I've already taken my 40% active weight, I've taken the positive positions where I like the stocks.
Yes.
And if there are some stocks that I think will really do nothing, I'll keep some cash, right? If I feel that these can be negative return, I won't invest for the sake of it. And I won't add more to the ones that I like because my active weight has the risk budget is done with, right? So in that sense, like cash becomes an outcome of the overall active weight budget, right? Because I'm not going to say, oh, I really like this, I'm going to become a 60% active weight fund, because that's not the
Cash is therefore an
there's an
what about a fund like a business cycle fund, Anish? How would you look at cash?
I mean, same, right? Like
Same.
you can have some cash, right? If you think, look, economic outlook is good, but valuations are not that cheap, so you might get some dips. You can keep that for the
So cash is more an outcome of your investment allocation and your activities, and then what you want to do with that.
exactly.
Fair. Question on SIP versus lump sum. We are, every day printing numbers of our SIP collections. Of course, we referred to it in the small cap space. A large part of that SIPs have come in the small cap space. But when you look at the table here, the lump sum returns and the SIP returns, even in the last period, which was the peak of 2024 to now, SIPs seem to be reasonably better off than doing a lump sum. And this question keeps coming. Should we do an SIP or a lump sum? Views on that in your
It depends a little bit on what is the nature of your flows, at which stage of your life cycle are you. If you're a young guy with stable income, which is salaried income, which you think will come at least for the next 20 years, then your inflows are monthly, so you might as well allocate it through a SIP, right? There's no point trying to, and you're not in the business of every day looking at the markets all the time.
sure.
So then it's better to say, look, I anyway don't need the money for 10 years, I'll put it in some equity fund, etc. Right? The challenge is if you have lump sum money, and then you have to choose between SIP and that. And the thing that here you've said, look, SIP still outperforms lump sum because we've been only in a flat market.
That is right.
Right.
I was about to refer.
Right. See, the problem happens if you deploy. So the real, if you are a lump sum, if you have a lump sum of money, the real question to ask is, will you chicken out if markets correct, right? That is the worst thing you can do if you do a SIP. So you have to be disciplined then about. Ultimately, answer comes down to discipline only, right? Because what would be terrible is if you average up, keep investing on the way up, and the market corrects, and then you back off, because then you've averaged up.
Sure, that is right.
That is
So most of our viewers, while this data talks about 2024 peak to now, like you very rightly pointed out, you have got a period where, at points in time in the last 18 to 20 months, dips also. So your averages would have looked better, which is what is probably a bit of misleading information. But
in general, if you're a long, like if you have a stable inflow which is periodic,
yes,
it makes sense not to accumulate
and deploy.
Then you
Then
systematically get
so SIP still remains to be seen through the the rupee cost average.
But don't chicken out when there's a correction.
Yes. So, Nish,
And that's where I think the partners play a very critical role.
so to all our partners who have been encouraging SIPs and the book that has got built over a period of time, fairly stable inflows that we are still seeing. And seizures are there, but like you said, it's a normal percentage. But yes, continue the SIP for the longest period is extremely important. Thank you very much, Anish. I think we will flip over to a few questions. I'm sure there would be questions that has come up. I can see a lot of questions have already come up. So there's a question which is pretty interesting, Anish. Is there a possibility that Indian markets can go to a long-term time correction, 5 to 10 years, the way you saw in Japan, etc.?
I don't think that's not my base case view, or even my conservative view of bear case view of earnings growth. Right, I do think the economy is in reasonably good shape. Uh, it is a growing economy, and if economy is growing, earnings should grow, and multiples would have to like really compress for that sort of thing to happen.
Participation.
To happen. And like the even large cap in particular is not looking that outrageously valuable. Japan, the context you have to remember, it was deflationary, so there was no inflation. Right here, inflation itself provides earnings growth, right? And that might be not real earnings, but it is still a positive number, right? So that was a deflationary period. It was starting at extremely high multiples. I don't remember the number, but it was very, very high when it went through a 10-year correction. And frankly, the economy was in a long period of slump. Both the real growth of the real average growth in the economy, anyway, in a developed economy is slow, and there was low inflation. Right? So the earnings outlook had to be disastrous for that.
Which is not the condition that we are in.
I don't think we are there.
We are in that condition. Yes. What's the outlook on the IT sector for the next couple of years is a question. And, companies moving into AI, less staffing requirement, etc. So does this also have an impact on the earnings part? Not the business earnings alone, but the overall economic earnings part also from the employment.
So that's a very interesting point, right? See, if you look at and the Indian IT industry, you should always remember the Indian IT industry is not just the listed Indian IT companies. The Indian IT industry is also the GCCs of various entities. It's also the like an Accenture or a Cognizant, which is a US listed, or a Capgemini, which is a European or a US listed companies, also have centers in
India.
So now, when you are seeing what's happening in Indian IT, you don't have to look at only the revenues or earnings of our
listed players.
If you look at overall software services revenues, they're actually doing quite well. Right? So it is the Indian listed vendors that are losing share while the Indian IT companies are still doing well. Right? So as far as the economic impact is concerned, I don't think at the moment there is a problem. If their AI causes problems, then I should see it in overall aggregate software services data, which I'm not seeing right now. So the question I have is, are the Indian IT companies still trying to achieve margin levels that are not sustainable given that the competitive environment has changed, right? What do I mean the competitive environment? See, if I look at the Indian IT sector over a 20-year view, right? There were only 3 or 4 good names in India. So a bank CEO sitting in the US looked at his cost in the US, so it's $100, and somebody from India with a good name is willing to do it at 30. So the comparison was 100 to 30. You didn't really care whether he's earning 25% margin there. So whether he should only be in reality charging you 25.
Yeah.
Right. So frankly, nobody is really, the gap was so large, right? But now that is no longer the case, right? Everybody has understood that you can go to India and get it done at 30. So the question has become, look, then what margin level is then justified? And think about it, right? If you found that you could do something in Kenya, an Indian business could start sourcing. They won't go and set up their own center the first day. They'll say, look, I want to source from there, but let me work with some local company from there. That's what you do, no? Why would you? But over time, if you become very comfortable with that geography, you'll say, look, I can set up myself and like not pay the supernormal profits that the vendor was. So that is, I think, the current stress is because of this change in competitive. See, the government has also changed how they're doing the tax challenge, the tax treatment of, like, earlier I have heard that there used to be a lot of tax disputes with GCCs, etc. Right? What is the transfer pricing, etc. I think a lot of that has been cleaned up, right? So if you say a reasonable markup, I don't know whether it is 15 or 20%. No questions are asked about the transfer pricing. So that has increased the comfort everybody has on GCCs. So I think at the moment, I'm not necessarily seeing the impact of AI if I look at the overall numbers. And the overall industry, not just the listed companies, are in reasonable hands.
Another, I think you have shared often a lot of views. The real estate cycle, residential as well as commercial.
No, so look, frankly, if I were to S- And I've always said this, right? How the country performs will depend on how much house building activity um, the if I were to say, look, 1 year later the economy is not regained momentum and the war has ended, the most if that were to happen, the most likely cause would be that house prices have gone to levels where affordability has got crushed. I hope that doesn't happen. That's not my base case. So volume of real estate activity is very, very important. I don't want many price increases. I think this time around the market should deliver that because there is RERA in place. So if you promise to build, you have to build. And also, see, the stock market this time is not valuing real estate companies on land banks. So it
You have to
disincentivizes
land
land
banks.
banking by real estate companies also. So they buy the land, they should sell it, and even if it's at a low
Well said.
then. So I'm hoping that both from a market perspective and from a regulatory perspective, pricing will remain at levels that sustain.
Sure. A lot of questions on IT, which you have answered. Question on what are your sector choices at this juncture, Anish?
So, as I said, I'm positive on the like I'm looking saying this war will end within a year. They should take at least a right. There's no point trying to say whether it ends in 1 month or if you take the view that look, this is a world war starting, then I'm not there, right? That's not my basis. We would
You must look at something else. Yes, yes. This book itself is not to be spoken.
for this time, not there. But if you say, look, this crisis will have ended, then you take at least a 1 year. And then you say, is that economy, how is the domestic economy? Should I think the economy should be quite uh, and things like people have been complaining, capex cycle, etc. Will also come back because capacity utilization has so capex cycles. So I'm reasonably positive on the. And if I take that view, I would still prefer being in financial, the cyclical sectors, financials, cement,
Or
automobiles, yeah, financial, cement, automobiles. Capital goods, I think the margin story has played out. See, when you get earnings growth from two sources, the revenue growth or margin.
margin expansion.
Margin story has played out. It's now so that rapid phase where you get very strong earnings growth because you're getting both margin improvement and revenue growth behind us.
Yes,
You only get now
the stable revenue. Revenue.
cyclically good revenue growth.
Okay.
It's a stable.
Those businesses. Yes. All right. Okay.
So expectations just have to align to the fact that earnings growth will be healthy but not spectacular.
Sure. Sure.
To that extent.
Sure. A very common question that often comes, and I also saw a few people have asked that is since we are talking about sectors and what to consider, is that we have seen a phenomenal run up in the markets post COVID till about mid 2024, and the return expectations just got went out of the park. What is a very realistic expectation if somebody were to look at it from these levels?
In line with earnings growth, not allowed to give expectations. See, my point is, look, this you can have an endless debate about multiple. Whether 21 is the right multiple or 19 is the right multiple or 23 is the right. But the reality is, if you stay in the market for 3 years and if you get healthy earnings growth, the change in multiples makes a smaller impact than big fund multiples.
And you having said that domestic economy is in a reasonably good shape and there are pockets of value available, you're reasonably confident about the earnings also. I mean, there would be sector choices and business choices, but earnings should be healthy. So that itself is a good, confident way to look at capital markets. Sure. So you did refer to it, but there is a question which has come. Are you a momentum investor? Which I'm pretty sure you maybe he missed hearing that. And if you look at historically momentum, there's other styles that has got beaten by the momentum style. I think the reference here is to certain indices which are probably run on momentum style, etc. So you want to comment on that, Anish?
Right, I like so actually, in fact, the modifications that we are bringing in at DSC are disciplines that prevent accidental monitoring.
So that answers. So Anish is definitely not a momentum investor, not a proponent of that style, and you would not.
Because I think index fund is the best momentum fund, then, right? Because it will keep on increasing the weight, whatever.
I mean, is good. Yes, right. Uh, Something on the metal part. There is a question on base metals and on gold.
So base metals is an interesting topic. So let's break it up into like three parts. Like copper, which doesn't take, there's really no play in India.
Yeah. Yes. Yeah.
They're basically like steel and
Aluminum.
so steel, right? Steel. Looking about steel. 50% of demand comes global steel demand comes from China, right? And I've been saying this for 3 years, and it hasn't worked, but it's worked in the demand supply thing, but it's not worked in the stock markets. I'll come to that. China has built all the housing and all the infrastructure that it needs to. If you build, so they'll keep on building houses, but at a
Smaller pace.
So if you build 50 million houses 1 year, next year you build 40 million houses, steel demand is negative. And also things like automobiles, once you bought enough automobiles, when you buy a new car and you sell your old car, the old car gets scrapped and just so it's almost like your old car is turned into a new
car.
So
Yeah, from a steel perspective. Yes.
So no matter how I cut the numbers, and I've been saying this for 3 years, steel demand growth from China is negative and will remain negative. And if 50% of your market is shrinking, India's 10%, no matter whatever positive now, global demand shrinks. Now, when global demand is shrinking, pricing environment will never be. So steel spreads will. And when people say steel spreads are very low, I said, yeah, you are comparing them with when demand was growing. Obviously, they have to be low so that capacity exits. If they were go back lower, new capacity will be added.
Yes.
So demand is weakening. You have to drive capacity out of the market. So the price
has to narrow.
So that has been happening also. What has worked for Indian stocks is government has been increasing. How long we should do it? My view is I don't think any more protection is justified. Because every time you protect an upstream industry, you harm a down. So if you protect steel, you hurt shipbuilding, you hurt. That's not my view. That is just reality of it.
Yeah.
So I don't think one should expect that steel protection will keep on
Forever.
increasing forever. Then the other aspect of steel profitability is iron ore. Iron ore steel demand is declining. Iron ore demand is also declining, and supplies. There are new mines that are coming on in Africa, in the case of Mandu. Brazil had been having supply problems. That is coming back. So I can't be positive on iron ore after. Iron ore prices were to fall, these prices would also fall. So I'm not positive. Aluminium, okay, at least demand is not declining. But I think aluminium prices are at very levels. 6 years back, when I bought a lot of aluminium companies, aluminium prices were at 1750. People told me you were really stupid to buy aluminium because aluminium prices will never go above 17. Because there's so much aluminium is so plentifully available in the world everywhere. There's bauxite is available everywhere. Now aluminium is at 3,000 and people are making a bull case for aluminium. The same people who were players at 17. I don't see why prices should be eventually supply. See the point that some people make that copper prices are so high and aluminum is being given up by copper. Copper is, I think, volumes are 1/6 of aluminum. So beyond the point, copper can't. So I'm short answer. I'm not positive.
Yeah, because you question. Yeah, steel you're not positive.
Explanation because
yeah, aluminum you did. Yeah, and anything on gold, Anish?
Additional way to price on somebody has said that the gold price has very solid foundations because it's founded on human stupidity and human stupidity has always been around. So gold is always a good asset. So the only way to think about it is that when those are people. See the people, the bull case that is made, right, which I'm not fully convinced of from here, right? Obviously, it has worked till now. Is that people don't like the dollar, so they will hold reserves in gold. So I don't disagree that the share of gold in reserves can increase, but I think the total reserves that are held can come down. I mean, there's no reason why China should hold $5 trillion of reserves in the first place. That part of their initiative around Belt and Road, etc., is to say we should not hold so much of reserves. We should buy actual real physical assets in these countries, right? Build a mine in Africa,
Yes.
build infrastructure in Africa. So that I think, while it's true that the share of gold in reserves might go up, the total reserves might not
Shrink.
might actually. So, but anyway, right? Just the price tells me that.
Uh, an interesting question. Do you think money will move towards the real economy rather than coming into the capital markets? Again,
So this is a straightforward question. There is no money in capital markets. Capital markets are a source of intermediation. What we hold as what a household holds as a financial asset is a financial liability. So always funds go into good assets. It is whether you buy the real asset is a house or a factory. That's the only difference. And ultimately both are needed. And some of it is reflects a confusion, right? Somebody buys a house with a loan. One household has saved, another household has dissaved.
yes.
So gross financial assets have gone up, but net financial assets of households also have not gone up. So there's a lot of, and this financialization narrative has been thrown up
A lot.
a lot.
Yes.
Actually, there is only financial intermediation. There are no ultimate financial assets. Somebody's financial asset is somebody else's financial asset. Ultimately, there are only real assets.
I see most of the questions are answered. There are a few questions. Anything you want to add on the fixed income part? There's a question I can see, which is an interesting one on the yield gap and on the overall interest rate outlook. Given your looking at the macro picture, anything particular about the fixed income part from a rate perspective, Nish?
Inflation is like, see, the way to think about is, should the central bank react and to inflation that is temporary because of oil prices? Normally, they should not, because this is, you have to distinguish between recurring inflation, which means continuous rising prices, and a
One-off price.
an oil price shock used to a one-off price shock. It is not something that the central bank. So I don't see that rates moving up, and the yield curve is reasonably steep. So I don't think that is much downside. Although there is uncertainty, so there is room for
I think we are done. The questions, couple of questions are repetitive. So just to summarize what Anish spoke about, domestic economy in good shape, sector rotation is something that will work very well with business cycle kind of funds, which is something that he's very confident about. Boom and slump of the economy and sectors available are different, but there is always a choice to make. And it's a good sector rotation strategy to play rather than getting carried away into only one sector or a thematic idea where entry and exit becomes a problem. Large caps, well positioned. You can always do a 40% active share and manage by avoiding the pitfalls on the bottom 30%. Again, a very, very strong contender active allocation for client portfolios. Do your asset allocation, MAF, DAF kind of portfolios, and all is well. Anything else, Anish?
to reiterate, significant corporate governance risks also in some of them.
Yes, correct. Yes.
Don't fall into the FOMO and the narrative that is created on both markets.
Right. Which is something which is a small cap always brings that extraordinary excitement. But I'm always reminded that you walk into a movie hall after the at the climax scene, and you just wish that the movie is played in front of you, which never happens. Uh, yes, correct. Absolutely. So thank you, Anish, very much. Thank you to all your partners. Yes, yes. Yes, and we wish your participation in our funds. We will come back stronger with Anish at the helm, and some of our funds are already things that you allocate to. And I'm sure with Anish being there, we will have far more depth and investment insights and more choices to offer to our partners. Thank you, Anish, and thank you to everyone who has logged in.